First up, we've got Nalan Vapra from Anchor Capital. Nalan, thank you so much for joining us this morning. Thank you.
Thank you, Eugene. Hello, everybody. It is great to be back in Durban. Haven't been here for a while. We've got an absolute gale blowing over there, so I'm going to stand over this side. It's, to be honest, a little bit easier for me. Downside is I can't actually see the screen with a timer on there, so Eugene, when you're really upset with me, you can stop me. But throw me another bottle. There you go. There you go. But it's nice to be back here to talk about fixed income. And challenge with fixed income is, as many people say, it's a particularly boring topic to talk about. And I guess some guys haven't come back from lunch, but we'll see them later when the fixed income guys are done. So what I want to do is talk just for a minute about the challenge we've got with this presentation. And it's a disastrous period for me to be presenting. And that's because we've all been in a very strongly trending market. At the end of the day, you know, every month bond yields are 10 basis points lower. You've made a little bit of a capital gain. The rand is a little bit stronger. And it's been a gradual trend. We've all ridden that in a fantastic trend to ride. But from a presentation point of view, it's disastrous because I have nothing to talk about. So what I'm going to talk about very briefly for the next 6 minutes or so is about what we said in July, what we said when this trend was starting. And in fact, it goes back to March, many of these slides. And I want to ask you, to focus on it, not so much from, we got it right. Hoopla, I think most people got it right. But the point I'm trying to make is that I don't see reasons these trends are going to break. I think this is going to continue for a while. That means that actually fixed income is going to continue to be attractive for a while. And I'll be honest, Eugene, you were talking about CPI plus 8 in bond funds. That actually feels low over the last 12 months. I'd need to go and check performance, but it's been a fantastic period to be in fixed income, and that will continue. So the first thing we spoke about was a political situation abroad, and President Donald Trump wants interest rate cuts. And he's going to get his interest rate cuts, and he was floating the idea of the chairman of the Fed, which technically he could do. But the point was he probably doesn't need to do that. He is in a position to exert enough political pressure to eventually force interest rate cuts. Not that I think the US needs interest rate cuts. In fact, I honestly question whether they should be cutting interest rates while inflation is at 3%. But nonetheless, the sort of direction of travel is that these interest rates are going to come through. That means from a fixed income perspective, the global cost of money is going to go down, certainly on short-end bonds. I think the long end might push up. Buy US bonds that have maturity dates between 4 years and 10 years from now. Do not buy 30-year US bonds. That's the trend that's going to continue as President Trump forces his interest rate cuts through the system. The second point I'd make is our Reserve Bank Governor, Kganyago, is a complete inflation hawk. He hates inflation. I happen to be a fantastic Reserve Bank Governor. I actually think he's done a lot of good things for the country, but I don't always have to agree with him. We don't agree with him on his view that we should change the inflation target to 3% in South Africa. I've been quite vocal about that. I've said that at BCI functions in the past. Plenty of YouTube videos of us explaining why. But the long and the short of it is that the path to getting to a 3% inflation mindset is actually going to be a very difficult one. I think, it's easy for us to talk about it in this room, but you go and talk to labor unions about saying, well, you've got to start accepting 3% wage increases. It's pandemonium out there. So from that perspective, there's a long journey he's going to need to undertake. And I think he is underestimating the challenge of that journey. Specifically, what that means is I think that it's going to be very difficult for him to cut interest rates much more in South Africa. Maybe one more cut this year. Anker's been saying that for a while. But then we kind of plateau out, and it just bobbles along at that level. So from that perspective, fewer interest rate cuts. That means South African interest rates are probably a little bit higher for a little bit longer. It means local interest is lacquer. You want to earn interest income. Local income continues to be quite attractive. Push on further, though, cutting his inflation target is very, very good for long-dated bonds, capital gains on long government bond funds. We measure that most of the gains have come through, but there is definitely at least sort of 3 to 5% further capital gains quite plausible if Kganyago gets his way. And I wouldn't bet against him. So from that perspective, we think that bond funds are quite attractive. Anchor, BCI, bond fund. What does that all mean for the rand? Well, I've just said that the US is going to be a little bit ill-advised in forcing through a few interest rate cuts at a time that, wow, every time I see this slide, the actual letters and shape of it changes. sorry about the formatting on this one, guys. Every time, so the Reserve Bank or the Fed is going to cut interest rates in the US, and South Africa is not going to cut interest rates. Interest rate differential is actually going to weaken the dollar a little bit, and the rand is going to look like it makes a bit of a recovery. Coupled to that, we've got an environment where gold price is supportive of the rand, terms of trade are supportive of the rand. Actually, I saw we've just had a sort of slightly better than expected economic growth output. It's slightly positive in South Africa's favor. We continue to have a view that the rand is going to inch its way stronger over time. And we've seen that of late. We think that continues. As I said, the problem I've got is all of these trends are likely to continue in the foreseeable future, and therefore, from a portfolio positioning perspective, the base strategic view is just continue to do what you've been doing because it's working. It is going most likely to continue to work in the future, and take a view on the longer term travel for the investments is definitely a good place to be. So that sort of sums up what our views are in a nutshell. But what I want to do instead, and what I want to do for the next 6 minutes or so, is just talk about the fixed income opportunities. So our job as fixed income managers, myself and the people chatting afterwards, is really to find additional ways of adding value to your portfolios. What makes us special? What can we bring to your portfolios that brings that little bit of extra juice, that little bit of extra shine that means we're more likely to sort of hover around the first quartile type area, because that's really what we're trying to achieve. So from that perspective, a little bit of a walk down memory lane. And that source of extra alpha has actually changed over time. In the early 2000s, the whole game in town was to take fixed income and mix it with listed property, because listed property behaved like a supercharged inflation-linked bond. Mammoth funds were built, and it was actually a very successful strategy. Until one day it wasn't, because the property market stripped its nature a bit. And since then, it's been a bit difficult for those strategies. But instead, what happened is from about 2013, we saw a scenario coupled, in fact, with quantitative easing abroad, where the South African rand just gradually trended weaker over time. What was the strategy? How did you win a raging bull in those years? You held US dollars. Whoever held the most dollars, benefited the most from the currency weakness, was the biggest genius. And that was the trend that persisted to about 2016, when that reversed, and suddenly, those income funds had negative years. But that was the game in town. That's what everyone was doing. What happened after that was the inflation-linked bond craze. So you couldn't find inflation-linked bonds for your portfolios. They would be auctioned off and they just disappear, boom, into pension funds. And this massive pressure to go and source them, and you were finding all kinds of incredibly sort of challenging mechanisms to go and buy some of these bonds, because there was this mass stampede for these investments. That paid off very well until probably about 2000-ish, if my memory serves. So I can't see the slides from here. Next game in town, corporate credit, 2018. You had to buy AT1, Tier 1 paper from banks. You had to buy bank Tier 2 paper. You had to buy credit, and credit was paying 2.5% credit premiums. It was absolutely fantastic. South African credit was too cheap, and that gave you a massive outperformance opportunity. That outperformance opportunity has run its course, and credit spreads are compressed. I think they're fair now. I don't think they're expensive, which is maybe a sort of point of departure from some of my peers. But that opportunity has run its course. And the point I'm making is these opportunities run their course. Structured bonds is the last one. And a similar story from about, in fact, Anchor did the first structured bond. So we did it in 2020. And what you would do is buy a government bond, hedge out the interest rate risk, and that leaves you with a floating rate bond, very stable in performance, paying quite an attractive credit premium. We did that. We were over a 5-year South African government bond, first one in the country. We earned 2.5% yield for our investors on that. Today, the competitors are doing this not on 5-year bonds, on 20-year bonds for 1.5% yield. Guys, don't take a 20-year risk for 1.5% yield. Okay, that's what's happening. And again, that train has sort of run its course, and you need to start looking elsewhere. And that's what Anchor brings. That's what we're doing at the moment. So where are portfolio managers looking? And really, as I look around South Africa right now, I see 3 core themes as to what portfolio managers are doing. The first one, I note openly, it's not Anchor's cup of tea, it's not what we're doing, but I'm just putting it here for completeness, and that's mixed rate notes. So what we're doing is we're buying a bond or from a bank that pays maybe JIBAR plus a 3% premium for the next 3 years, and thereafter it pays a fixed rate of 9%. And the whole idea is for the next 3 years, I've got a very stable investment in my portfolio, I'm giving you 3% in, looks fantastic. What's the downside? In 3 years' time, who knows if 9% is the fair market rate? What if my competitor funds are all doing 10% at that point in time? Well, then my portfolio is basically going to sit and start sucking air because it's not going to be competitive anymore. So not all portfolio managers are taking massive risks in this point, and there are lots of ways you can sort of mitigate it. But the point is, I don't like risks that make me look great today, but I know there's a sting in the tail later. There are, however, a number of these in the market. Standard Bank's openly saying they did 58 billion rand of these notes over the last year. So where is Anchor looking? And firstly, we are looking at duration. We think duration is quite cheap. So what that means, and I've got to pick a board here, I'm going to go on this one, is we've got a table here that lists all the South African bonds down the right-hand side there, in sort of order of next to mature through to the 2053 at the bottom, which is the one that's going to mature last. Across the top, we look at what the yield curve does. So let's start with a 0, which is in the middle there. And that 0 is basically saying, if interest rates stay exactly as they are right now, they move by 0, then what will I earn by owning this bond, the 186, for 12 months? And the 186 will return to you 7.32%. And we can calculate that for all the bonds. So I know if I own the 2053 for 12 months, it's going to return, as long as I'm not squint, 10.26%. So you can see exactly how much more I earn over the next 12 months from the different bonds. The point I'm making is that this is particularly steep. So that's almost, a 3 sort of percent increase over time. We look at the locking in money for 10 years, you're earning 9.56. I'll go out to 20 years, 10.72. Obviously, the 10.72 is a more attractive investment to us. But what about the risk? I need to think about the risk, because obviously locking in money for a longer period says that those bonds will be different, and how they behave in different scenarios will be different. What is interesting at the moment is that the risk actually favors the long-dated bonds as well. It becomes less risky for now. And what I mean by that is you say, well, if yields go up from 0% to plus by 0.25%, so all interest rates go up unexpectedly by 0.25%. I've got a capital loss on the bond. What is my 12-month return on owning a 10-year bond? And it'll be 8.11%. Interestingly, in that exact same scenario, interest rates go up by 0.25%. What is my return on holding a 20-year bond? It's 8.74%. I'm still, even in an adverse scenario, earning more on the 20-year bonds right now. And even across to sort of interest rates going up by 0.5%, I'm earning more on the longer dated bonds. And that's just a function of the shape of the yield curve, how longer dated bonds are incredibly cheap right now and unduly cheap. So from that perspective, what we're saying is actually there's more upside in bonds, in the long dated bonds, and we're in an adverse scenario in South Africa. Actually, it's okay. Those bonds are still going to actually outperform the short-dated bonds. This is a good time to be putting these bonds into our portfolios. So we have been tilting very much in our portfolios across the board into these bonds. The final point I'm going to make is that we've also been actively looking at credit risk. South African credit risk is fairly priced. The rest of emerging markets is not. So we've been looking at emerging market issuers throughout the region, including the BRICS countries, excluding Russia. My PM was very upset that I had a Russian flag there. So we have not lent any money to Russia. We have no intention of doing that. But we are looking at other BRICS countries and saying, are there interesting credit opportunities? And I can lend money to the South African government and earn, over 5 years, the floating rate notes are offering, credit premium 1%. Or I can do that in Brazil and earn 3%. Might as well rather lend a little bit of money, diversified basis, very judicial in our risk usage. But I can lend money to other countries, earn a more attractive return for you, and actually, in the long run, your clients are going to be better off, your investors are better off, and in the short run, and the risks are actually very, very well contained. So with that, why anchor fixed income? And I've got to end it there because I see a big red flashy thing on the screen there. But why anchor? Yes, we're riding the same trends as everyone else. Yes, we're doing what everyone else is doing. We're doing it very well. But we're looking for those extra opportunities. We were the first guys to structured bonds. We've done some Brazilian debt at the moment. We are constantly seeking interesting opportunities to add that little bit extra to you. And with that, I'm going to hand over to JP Duplessis. I'm not. Eugene looks like he wants to hand over, so I'll run away.
Not just yet. I just want to check if there's any questions from the audience. Right, one quick question from me, Nolan. You showed previously the ILB craze. Lots of people talking about ILBs now again, inflation-linked bonds. Are we going back to that craze, or do we just add more duration?
Add duration. Honestly, if I believe our Reserve Bank governor is good, which I do, I believe inflation is going to 3%, and I don't want to own an inflation-linked bond at 3% inflation. It's it's got its time. It has added value to portfolios in the past. I don't think now's the time, and certainly within Anchor, we're not looking at it.
Nolan, thank you very much. I know you've got to run for the airport, so you're not joining us for lunch, unfortunately. But if you want any more info on the Anchor and the Anchor funds, we'll get you in touch with Nolan. Thank you so much.